All right, everyone. Welcome to the 15th Daily Gwei AMA. Thank you all for being here. As usual, if you would like to ask a question, you can raise your hand and I'll invite you up onto the stage, and I'll be taking all the questions from the AMA series channel in order. You can also ask a question in there and it'll be answered towards the end of the AMA. Of course, as usual, this will be recorded and uploaded to YouTube with timestamps within 24 hours. So without further ado, let's get started with the first question from the AMA series channel, which comes in from Yon the Fawn, who asks, are the L2s on Ethereum in direct competition with one another? For example, is StarkNet competing with IMX to be the NFT layer on top of Ethereum? So I'll kind of answer the first question. I guess it's a yes or no answer. I think that all the L2s on Ethereum are competing with each other, yes. Just like they would, they're competing for like liquidity, developer mindshare, applications, all that sort of stuff, right? But it's not unhealthy competition. It's not parasitic. It's actually healthy competition because they're all kind of like, well, at least most of them, not all of them will be like this, but like most of them have the same kind of goal in mind, and that's to use Ethereum as this decentralized, secure settlement-based layer, and then scale Ethereum at layer 2 and allow users to tap into Ethereum layer 1's properties. So from that point of view, it's kind of healthy competition. But, as time goes on, there's definitely going to be changes where there's going to be roll-ups that are much more aggressive than other ones. For example, we're already seeing the early stages of this right now, right? Like Boba Network is a modified fork of Optimism, and they're being more aggressive about how they're attracting capital because they have a token and they're doing airdrops and liquidity mining and all that sort of stuff there. I'm sure Optimism will do that later on. I'm not sure when they're going to do it, but I would bet that they would do it. But the thing is, Boba Network beat them to the punch and he's being more aggressive about it. And that's just the early example of what's going to happen where, yes, the competition is healthy, but there is competition there. So yeah, I guess to answer, as I said, like the answer is yes and no. Yes in the fact that they're all competing with each other for the things I outlined, but no in the sense that it's not competition like it is with other L1s competing against Ethereum, for example, right? Or trying to compete against Ethereum's L2 ecosystem, where they're just trying to like get users to come away from Ethereum onto their own ecosystems. That's very different when it comes to the L2s. And then you kind of ask, is StarkNet competing with, as an example, is StarkNet competing with Immutable X to be the NFT layer on top of Ethereum? So the thing is, Immutable X is built using StarkWare's technology, their StarkX technology, and if Immutable wants to, they can join StarkNet as a kind of like a roll up in as part of that kind of network there. So I wouldn't say that they're competing. But if you're looking at other kind of like ecosystems, for example, Optimism and Arbitrum being the two premier optimistic rollups, they're obviously definitely competing as well, right? They're competing across a number of different kind of like fronts there to be the best optimistic rollup on Ethereum. Same goes for the ZK rollups. Obviously, ZK Sync is competing with StarkWare, is competing with Polygon. They're all competing to be the best at what they do. But as I said, it is kind of like a healthy competition. I haven't seen any unhealthy competition yet, but I do expect that to change as time goes on, where we get like more aggressive kind of like roll-ups. As I said, we're already seeing the early stages of this happening with Boba Network, and I'm sure there's going to be others like coming very soon as well. So it's going to be interesting to see how that all shakes out. The cool thing about L2s is that it basically detaches kind of like that tribalism or that tribalistic parasitic competition where the L2s, if they're competing with each other, it's fine, but they're not competing with Ethereum L1. They're actually all benefiting Ethereum L1 because they're all paying ETH gas fees to secure themselves. They're all burning that ETH, right? Like that most of that ETH gets burned when they pay that. They're basically letting users tap into Ethereum's awesome properties, which are its decentralization and security, and they're breeding healthy competition at the execution layer, which is obviously the roll-up layer. So in all honesty, I think that it's actually incredibly healthy that we have so many roll-ups already, and we're going to have many, many more, as I mentioned in the refuel plenty of times. I expect roll-ups and L2s to be the new L1s going forward, because it just makes a lot more sense. And the beautiful thing is that Ethereum benefits from all of it. So that's why, that's obviously one of the reasons why I'm so big on ETH as an asset. It's just like a no-brainer bet on the entire Ethereum ecosystem. And, everyone, no matter if they're kind of like competing with each other, like, DeFi apps compete with each other, DAOs, different DAOs can compete with each other, all that sort of stuff, like NFTs. it all goes back to Ethereum. Like Ethereum benefits from all of it, which I think is really, really cool, and basically makes it very different from, L1s competing with Ethereum. It's kind of like now the L2s compete with each other, and Ethereum L1 benefits from it. So yeah, hopefully that answers your questions there, Yon the Fawn. I know you have a few more in here, which I'll get to, but the next one comes from FlexBC, who asks, I was in a discussion with a BTC Maxi, and he questioned me on if Ethereum is quantum resistant. Is it quantum resistant, or will it become resistant in the upcoming upgrades? It's not. And look, I think quantum resistance is a bit of a red herring. It just seems like such a... It's talked about from time to time, and if there's some tech blog that writes something about there being a breakthrough in quantum computing, and they're saying, oh, it's around the corner, whatever. There's a lot of this clickbait happening within the computing world with regards to quantum computing, but it is something that has been talked about by the Ethereum community. Vitalik has spoken about it before, I believe, and there are plans to make Ethereum quantum resistant, if it needs to be, right? If there is an impending threat, then Ethereum can simply kind of like hard fork, network upgrade to become quantum resistant. And as far as I know, it doesn't seem like it's a difficult thing to do, from what I can tell. But maybe my information's old there. Now, the funny thing is that a BTC Maxi was asking you this, right? I do wonder if Bitcoin has the culture to be able to upgrade this quickly, because they obviously have an anti-hard fork culture. They don't like doing any hard forks or network upgrades. They only like doing the network upgrades by the soft forking, which in my mind is basically worse than a hard fork, but we won't get into that discussion for now. So I do wonder if that community would come together if there was an imminent threat and hard fork Bitcoin to be quantum resistant. I think they would. I think that, as kind of like hard-headed as the Bitcoin maximalists are, they do first and foremost care about Bitcoin, and they only don't want hard forks because it goes against their kind of, I guess, like ethos, it goes against their values. But if there's like an impending network threat, and there's a credible threat, then I do believe that eventually they'll get to the right kind of like right place where they'll hard fork to become quantum resistant. But I think that Ethereum will do it much sooner, because Ethereum has a culture of network upgrades, of hard forks. It's not a surprise whenever Ethereum does this or announces a new one. It's kind of it's expected, right? And the community's bought into that, because if you're in Ethereum, you're bought into the way Ethereum upgrades itself. So yeah, hopefully that answers your question. All right, Vern, I'll invite you onto stage here. It seems you've got a question for me. You just got to click accept. There we go.
Hello.
Hey, how you going?
Hey, Anthony. Good to talk to you.
You too, mate.
Hey, yeah, two relatively quick questions. One, I'm starting to get through these airdrops. I'm getting a lot of ERC20 tokens that are becoming increasingly valuable. Are there any specific hardware wallets that you know of that are best for those? For basically non-ETH, non-BTC tokens. And then secondly, do you know of any ways, like in Dune Analytics or elsewhere, that kind of dashboards that look at overall leverage in DeFi? Those are my two questions. Thanks for taking them. Appreciate it.
No worries. So yeah, I guess like to your first question, any hardware wallet that supports Ethereum will support ERC20 tokens, because they're, it's the same kind of like ecosystem, obviously, an Ethereum wallet and ERC20 tokens, they're kind of compatible. So that should be fine. There are different apps for these hardware wallets that may not have like out of the box support. Like Ledger Live may not have support for some token, whatever it is, and you may not be able to see it in their app, but you would be able to see it on another kind of interface, whether that be something like MetaMask when you connect your hardware wallet to MetaMask, or My Ether Wallet or My Crypto or anything like that. So there should be no worry there with ERC20 tokens, because they're ERC20 tokens. They're supported, naturally by every Ethereum wallet, because the format, that's how the kind of like Ethereum account works and Ethereum wallet works. In terms of like which ones I would recommend, the only two that I've kind of like heard a lot of good things about over the years, I've used myself, I've never really had issues with, are both the Ledger Nano S or X. S is the non-Bluetooth, X is Bluetooth, and it's a bit, looks a bit nicer, I guess. And then the Lattice One, which is a bit bulkier. Well, I guess it's a lot bulkier. It's like basically a unit that sits on your desk. You can Google it, Lattice One from Grid Plus, if you haven't seen it yet. But it is, much more secure than a Ledger. It has so many different different things built in to secure itself. It's actually pretty crazy what they've done with it. It's got like tamper resistant. It's basically, I mean, from what I can tell, it's basically not impossible, but like very, very hard to crack into this thing. And it's really great at securing everything that you've got. And it also works with MetaMask as well. So those are the two kind of things. I've used both, as I said, and I still use both the Ledger and the Lattice one. And yeah, as I said, like depending on what interface you interact with, will one might not show you the tokens that you have, one might. But at the end of the day, the tokens are there in your wallet. You'll always be able to access them. It's just depending on which interface you want to access them from. So yeah, hopefully that answers those questions for you.
It does, yeah, thanks. Appreciate it.
Yeah. So and the second one about the leverage. So I don't know of any dashboards that track leverage in DeFi. The one I use for CeFi is bybt.com. I think that's it. Let me just quickly look. Yeah, bybt.com. That allows you to track open interest, liquidations, funding rates for centralized finance. But in terms of DeFi, no, I haven't actually come across any. I haven't really particularly looked at it either. I think maybe DeFi TVL is a good metric for, or I guess a good kind of like barometer or something, a good piece of signal that you can look at. So if like TVL seems to be going up in lending protocols, or if kind of like rates are kind of creeping up in terms of like stablecoin yields, that probably signals there's leverage in the DeFi ecosystem, because at the end of the day, most stablecoin yields, if not all of them, come from some form of leverage. So yeah, unless you've seen something else that I may have not have seen.
No, that's yeah. I was trying to see if there's a way. I figured it'd be hard to get a specific look at that, but maybe those are good like approximations of that to be interesting. So I'm looking to see like to what extent we can see sort of systemic risk. Because I worked in finance for a while, and there, this is like 2008 back in those days, and back then you couldn't tell what the heck was going on. So what's so great about DeFi is that there's so much transparency.
Mm-hmm.
I'm curious to see how is it, okay, you can actually see all the systemic risk build up and where it can be accounted for, where it can be modified or whatever. So, but yeah, I think those are good approximations. I've looked at this too. Thank you for confirming that.
Yeah, no worries. And yeah, I mean, I'm totally with you. And yeah, the beautiful thing is you can see where all the assets are on chain anyway. But as I said, like I think stablecoin yields are a good proxy for leverage in the system. So if stablecoin yields are high, depositing your stablecoin into like a yield farm and it's not giving token incentives, it's just giving kind of like natural yield and it's high, I would say that's probably the best approximation in DeFi for leverage across the system.
Cool. Thanks, Anthony. Really appreciate it. Love all your work. Thanks.
No worries. Thanks, mate. See you later. Cool. All right. On to the next one from the sheet here. Comes in from Danny. Hi, Anthony. I was really worried the other day when you mentioned in the Daily Gwei that MetaMask plus Ledger Nano is a risky wallet option because of exposure to man-in-the-middle attacks and other risks. Is this a big deal? Look, if I'm being honest, it's a big deal in that it's scary because you don't know that it's happening to you unless you're like checking everything that you're signing, right? Like, as I said on the refill video, just to give context for those who maybe didn't catch this, essentially what can happen with a man-in-the-middle attack is that you can submit a transaction on MetaMask, right? And you can interact with like some Web3 app, say it's a Uniswap, and you say, okay, I want to swap these tokens, and then you'll get the normal MetaMask pop-up that says, hey, confirm this transaction. Now, a man-in-the-middle attack, what ends up happening is that it can actually fool you into signing something that you didn't trigger yourself. So it can actually replace that Uniswap transaction that was sent to you from kind of like Uniswap. It can replace that with their own transaction. So for example, say you've submitted a transaction and you need to sign it to swap USDC for ETH on Uniswap. Now, that transaction obviously in the normal case gets sent to your MetaMask or other Web3 wallet. You confirm the transaction after putting in gas price or just like confirming it without changing the gas price, and then it goes into the mempool and then it gets executed in after some time. Now, in a man-in-the-middle attack scenario, that Uniswap trade that you did, that transaction would never actually hit your MetaMask. What would happen is there would be another transaction that was crafted by the attacker, probably automatically by some form of malware that was on your PC, and they would replace that trade with send these kind of like coins or send this ETH to this address, the attacker's address, for example. And then you, thinking that the transaction that's gone to your MetaMask is a Uniswap trade, the Uniswap trade you initiated, you would just like sign the transaction, right? You'd say confirm, and then you've actually confirmed that you're going to send these funds to the attacker, and you won't actually realize that until the transaction confirms, and then you go to check if you got the funds from the Uniswap trade, and that what isn't what happened, and all your ETH got sent to this attacker's address. So that's what's very scary about it. In terms of like worrying about it, I would say that for most users, it's probably not something you're gonna worry about like too much, because these kind of things are probably more targeted towards known people, like well-known people, and like targeted attacks and stuff like that. But at the same time, I worked in cybersecurity for a long time, and it's amazing to me how easily people got themselves infected with malware, because for this to work, you would need to get infected with some form of malware, and it's actually quite easy for malware to enter your PC, because the easiest thing, it's a lot of you would probably be familiar with this. The easiest way malware gets onto your PC is if you open some kind of like attachment, or you download some file, and it's got a piece of malware attached to it. It just installs itself on your PC. It can do this completely in the background, by the way. You will have no idea that it's happening unless you run like antivirus software that has it cataloged, and they can actually pick up on it. But if it's like a new strain, or if it's got like evasion techniques or whatever, it can install itself covertly and then basically do its job in the background. So I don't mean to scare anyone with this sort of stuff. And as I said, like a lot of the man-in-the-middle attacks that I've seen have been more targeted. But at the same time, if you want to keep yourself like super secure, especially for high-value transfers, I would definitely make sure that you look at what you're signing. Like if you're sending high-value transfers, like and high value is relative. Say your portfolio is worth $10,000. If you're sending the whole thing to an exchange, or if you're trading the whole thing for something, well, you might want to check that transaction, right? You want to double check that transaction. The one that you're signing is actually the thing that you're actually trying to do, and not a man-in-the-middle attack. Because if you don't, you could end up losing all your funds, right? And the thing is, a hardware wallet will not protect you from this, because a hardware wallet just allows you to keep your private key off your kind of like PC, keep it on this little kind of like a device that the private key never leaves that device. It's secure there. But the problem is that it's the same transaction flow. If you sign, how on a ledger or a lattice, it comes up with the same kind of flow. Confirm the transaction after you've confirmed it, kind of like through MetaMask, or if you're doing a MetaMask pass-through, and then you sign it, and you'll be signing the same thing, right? You'll still be signing a malicious transaction if you don't check it. It doesn't. The hardware wallet won't help you with this. So that's why I've been recommending the Lattice 1 to people lately, because on the ledger they have this thing called blind signing, which means you can't actually see what you're signing at all. And even if you do see what you're signing, you can't really see anything because the screen's so small. Whereas on the Lattice, it's got a bigger screen. You can see the whole transaction, and you can actually sign it and knowing exactly what you're signing. So from that perspective, if you do care deeply about security, and you maybe on the paranoid side of things, which to be honest is not a bad strategy, being on the paranoid side of things, I would definitely get a Lattice instead of a ledger, and make sure that you can see the whole transaction before you sign it. So yeah, hopefully that answers that question there. So I'm just bringing up my sheet here. Where was that question from? That was from Danny. Yeah. So hopefully that answers that there. All right, next question comes from S. Clark, who asks, in regards to a recent Refuel episode where you mentioned Alameda was a VC in StarkWare, I'm wondering what you think their game is. I thought Solana was trying to pitch that it doesn't need L2s to scale. So look, Alameda, SBF, FTX, whatever, they're profit maximalists. They're in this to make as much money as possible. I don't think they're in this for the crypto vision or mission. I'm pretty sure SBF has said this before, that he's in this because it's the easiest way to make money in the world right now, which it is, because he's made himself extremely rich off of crypto in just a few short years. So I would say that they are backing things or investing in a lot. They invest in a lot of things. Alameda is invested in hundreds of projects, and because for them it's very low risk, high reward. They throw a check, which is probably a very small amount of, like, if they throw like even a couple of $1 million at a project, which is probably on the higher side of things, that's nothing to them. These guys are multi-billionaires. They manage probably tens of billions of dollars of capital. That's nothing to them to take like a bet. And if it goes to zero, they don't care. Like they probably just make that back in in a day or something, or even less than that. So I would say that them backing StarkWare is literally just a play for more profit maximalism. They probably, I mean, I can't speak for them, but I would wager that they don't pay that much attention to what StarkWare is doing or kind of like help them with anything. They are, I mean, Alameda is the market maker side of things, and FTX is like the exchange side of things. So yeah, I don't think that I would classify Alameda as a VC either. Like this is what's actually been getting on my nerves a little bit lately, is that there's a line blurring between VCs and funds. They're very, very different beasts. A VC, like a typical VC or a traditional VC venture capitalist firm or individual or whatever, usually has a longer time frame, like 5 to 10 years. But because crypto is so accelerated, these time frames are becoming compressed. And now I would say that you can forget about having a 10-year time horizon in crypto as a VC. It's just not going to work out. You have to have at least at maximum 5 years probably. And even that's probably stretching it for how long, a trade can play out or an investment can play out, because this ecosystem moves so quickly. So from that perspective, funds usually have a much shorter life cycle, 1, 2, 3 years. So now the line between funds and VCs are blurring, because VCs need to shorten their their time frame as well to keep up with crypto, and funds are kind of like now selling themselves as being VCs because of those lines being blurred. As I said, I find this really annoying because there are a lot of good VCs out there. There are a lot of VCs that help their portfolio companies. They don't just spray and pray in everything. They're pretty targeted about their approach. They like to kind of like be involved with projects, like to help them. And then there are a lot of funds who are literally just investing in these projects to make as much money as possible. They don't really care. I mean, not all of them, but a lot of them, because of the fact that this is the way they're structured, they don't really care too much about helping the project out. They just kind of like give the money in there, make sure they know what their vesting schedule is, and then go about their merry way. So from that point of view, I would say that, I guess I would say that those lines being blurred has actually been damaging to the space at this point in time. I would say there's not actually many good VCs left. There's maybe, I don't even know if there's many good funds left, because as I said, those lines are blurred. I don't even know what's a fund and what's a VC firm anymore. It typically is that they're pretty much like the same thing at this point in time, which is kind of like hard to navigate through. So hopefully that answers the first part of your question. And the second part, you said, I thought Solana was trying to pitch that it doesn't need L2s to scale. Look, Alameda took a huge bet on Solana, of course, and so did SBF and FTX. They've made a lot of money on Solana, like billions of dollars easily on the Solana, on both the Sol token and the Solana ecosystem, because there were early backers there. Which is whatever. But if you take that context and then you kind of apply it to what they're doing in their kind of like investment spree, it doesn't really kind of gel or map, because as I said, they invest in everything. So I don't think they actually even think about their investment in Solana when investing in something like StarkWare. They just see a deal term that comes to them, or some kind of like terms that come to them, and they're like, okay, well, let's put some money into this. We know, they may know that it's a big deal for another ecosystem. They may know that it's a hyped up project, and they kind of like invest in that way. And I guess like on the technology side here, I've been saying for a very long time that Solana is either going to become a roll-up on Ethereum, or it's going to have roll-ups on it, and that's how it's going to scale. And it's not just exclusive to Solana, it's all the monolithic L1 chains. They're on borrowed time. They're already dead in my eyes. They're a technological dead end, just like I believe Bitcoin is a technological dead end, and proof of work is a technological dead end as well. Maybe those are more controversial opinions. But I've said plenty of times before that whether they want to or not, Solana is going to scale via roll-ups. But the thing is that why would you, as a roll-up, why would you even care to deploy to Solana, unless you're trying to do it for some kind of opportunistic thing where you're riding the roll-up hype and you put it on Solana so you can issue a token and have that token go up in value. But for long-term health and the long-term actual kind of like sustainable roll-ups, there is literally zero reason not to anchor yourself to the most decentralized and secure chain in existence. I mean, the only reason I can think of, and this isn't even really a reason, is that you may want to save on costs, right, as a roll-up. But the thing is, these roll-ups are going to be so popular, they're going to have so much transactional activity that the L1 fees are going to be aren't going to be that much of a concern when you're making so much revenue on L2. I see no reason for these or L2s, these rollups, to ever settle on anything that's not Ethereum in terms of like fundamental reasons. Profit reasons, that's a different kind of like story. They'll probably do it because they'll be able to push a narrative and say, oh, we're a roll-up on Solana. Like, look how well the roll-ups on Ethereum did. And you know how it goes, right? It's the same story that played out with all these EVM sidechains that did exactly what Ethereum did in DeFi summer. Liquidity mining, having a whole DeFi ecosystem, all EVM based. They just did the same thing. They ported it over to Avalanche and Phantom and all these other EVM chains, and it worked, right? Because narratives are powerful. So I expect the same thing to play out on these other chains. I expect I actually do expect StarkWare to deploy their tech to Solana eventually as well. There seems to be a bit of overlap with those kind of teams. But again, I just don't see the point. I really, fundamentally don't see the point in doing that. And it's not just because it's Solana, but any chain. I don't see the point of anchoring a roll-up to any chain except the most secure and decentralized one, which is obviously Ethereum by far. It's not even a question of what's first in terms of, being able to be anchored to. Obviously, Bitcoin can't support roll-ups, so that's already out. So it's Ethereum, and then there's a long list of others that aren't even, they're all fighting to be in second place. They're not even close to second place. So yeah, hopefully that answers your question there, S. Clark. All right, on to one from Max Invests. I've come to the conclusion that Ethereum no longer competes with alternative layer ones. Ethereum is objectively the best settlement layer and it has made this path clear. All of these other layer ones will need to choose between settlement and computation, and it seems like they will choose computation as they are good at this. Also, I don't like the L1 and L2 terminology, to be honest. I prefer computational layer and settlement layer. Do you share this sentiment? I mean, I think it's pretty obvious from, if you listen to the refuel, that I definitely share this sentiment, and I think that there's literally no competition right now for Ethereum L1 as a settlement and security layer at all. There's no one even trying to do this. If you had to be charitable and say, which other ecosystems are trying to go down the same modular path that Ethereum has been going down, I would say that Celestia may be the only one, but they're doing it a bit differently as well. They're actually not having any execution on the quote-unquote L1. They're just doing it all at quote-unquote L2. But I also share your sentiment around the terminology not being the best either. But at the same time, these kind of terminologies are hard to break for the mainstream. People are still using the ETH2 terminology because of the fact that it got memed, right, into reality, and it was used for a very long time. So changing terminology is very, very hard. So I'm not even going to bother doing that. But I definitely will still push the kind of modular terminology where it's the separation of concerns between data availability, security, and settlement, and execution, right? But at the same time, that's for people that are in the weeds. For the mainstream normies, as we like to call them, I think the L1 and L2 terminology is definitely the path forward for the short to medium term. And in the long term, most people are not going to care about what we call this sort of stuff at all. Most people are just going to be interacting with Ethereum on these L2s. They're not even, it's going to get to a point where they're not even going to realize they're interacting with Ethereum because these L2s have their own branding. You can imagine someone saying, oh, I'm minting NFTs on Immutable. This is really cool. And having absolutely zero idea what Ethereum is, and absolutely zero idea that Ethereum is the thing kind of securing Immutable, and Immutable is putting their proofs on Ethereum, and you can bridge to Ethereum and stuff like that. It's going to be abstracted away completely. So I think if we're talking about terminology for the insiders, it's going to be in flux all the time because it changes pretty regularly, especially considering that Ethereum's roadmap is in flux a lot. And I mean, the general high-level roadmap is kind of not set in stone, but it's kind of well known. But the implementation details are in flux, the terminology is in flux. So I would say that even though it may be inaccurate terminology, it's still something that we can just use, and we can chop and change with the modular stuff, because I think if you're in the weeds, you understand the kind of key differences there between them. So yeah, hopefully that answers your question, Max. All right, one here from Handasa Tak, who asks, can contract-based wallets like Argent just bridge all the ETH in the contract from L1 to L2 on behalf of all their wallet application users, since it's a multi-sig contract with the keys owned by the team? Wouldn't that be cheaper than each of us bridging individually and pay the high gas fees? As far as I know, I don't think that the Argent team has access to anyone's funds, even though that they're a multi-sig key holder. It would require you to sign any transactions if they put, if they wanted to kind of do something. I would require you to sign it as well. So they can't do anything with your funds without your permission, as far as I know, unless they can. I don't think that's the I don't think that's the case there. But in terms of like getting people onto L2 from L1 on behalf of users, I actually wrote about this in the newsletter the other day. It's called All on Board, the newsletter. If you want to go read that, it was Friday's one, so it's the latest one, where I basically said that there's various things that teams can do to onboard people to L2. We saw DYDX do what they call gasless deposits, which is basically paying the gas fee for people depositing into DYDX with $1,000 or $2,000, and then make their kind of like logic is they'll make that gas fee back from trading fees or maybe liquidation fees on the platform, and in the process they basically get a new user. So it's basically a customer acquisition strategy there, and there's a cost to doing that, of course. There are other ways that can be done to get our funds from L1 to L2. There's batched onboarding. Solana Network is working on this sort of stuff, and I think a few other kind of like teams as well. There's the teleporter for Optimism as well from the Synthetics team. I think that's quite limited right now, but that's another kind of like initiative. Then there's the rollups themselves being able to subsidize costs for users, right? To get them to kind of like bridge in. Argent could do it as well. You know, when Argent launches their L2 support, they could offer a thing to users saying, hey, bridge your assets to these L2s and we'll kind of like cover the gas costs for you. Because it was funny, originally Argent was actually covering the gas cost to create smart contract wallets in their platform, but then it got way too expensive. Like, I'm talking, they were doing it when the fees were definitely a lot less than $100 to create these wallets. Now to create this wallet, last time I checked, is you know, hundreds of dollars. So they're obviously not going to be able to do that in a sustainable way for end users, but to bridge assets across, they could do that, I think. So we're going to have to see how they kind of like, how that shakes out. But at the same time, as I said, like, I don't think that they, as far as I know, they can't access user funds without the user signing the transaction as well. So just because it's a multi-sig doesn't mean they have unilateral, they don't have, because it's a multi-sig, they don't have unilateral control over the funds there. So hopefully that answers your question. All right, one here from Yorn the Fawn. Could you please explain to us how these new domain resolvers work, e.g. ENS, unstoppable domains, decentral web, etc.? Are these simply organization partnerships with wallet providers whereby the wallet providers agree to look up a name, address mapping in a specific contract? And how are these assurances that two different decentralized domain providers aren't going to use the same TLD extension and thereby create mapping conflicts? So all of like for ENS, for example, all of it is handled by the smart contracts. So if another system came along, forked ENS, it would be a different set of smart contracts. So you actually can't have mapping conflicts at all, because there would be a completely different set of contracts, completely different set of controllers around those smart contracts. If it's if it's the ENS governance forked, or if they're just doing it through a multi-sig wallet, and even if there was the same name, say you had like Sassel.eth on the original ENS, and then you had Sassel.eth on the forked ENS, it would still be different contracts. Maybe it still maps to the same kind of address, but the thing is, the wallets that are adding support for this sort of stuff have to support the forked ENS as well, right? So in terms of like support for these things, they have to actually point to the contracts. So right now, they're all pointing to the original ENS smart contracts, right? And I don't see a reason why they would change that, because the whole ecosystem and community would basically say, well, it doesn't make sense to support a forked version of ENS, because ENS is fine the way it is. It's community governed now. It has all the mapping, has everything going well for it. Maybe in the future there is something that goes wrong with ENS and we do have to fork off of it because the original one, something bad happens. Well, in that case, it would take the community to come together and convince the wallets and everything to support the new one in addition to the old one. So in terms of conflicts, it's pretty much impossible for that to happen because of the fact that it's all based on smart contract logic. Not even just between like ENS and its possible forks, but also unstoppable domains and decentral web. It's all running on different contracts, so it's literally impossible for there to be mapping conflicts. So yeah, hopefully that answers your question around that. And as I said, like it's up to the kind of like the wallets to point to the correct contracts and resolve the correct names. Because whenever you put like, say you're in like a mobile wallet that supports ENS, I think Rainbow supports it, put Sassel.eth in there, they're looking up kind of Sassel.eth using the ENS contracts and looking up what that resolves to, which is obviously my Ethereum address, and that's how they map it out. Now, if they were to look that up on the forked ENS, it would be a completely different thing. I could have a different address set there, or someone else could own Sassel.eth there, and it would be different to the new one. But it could be confusing for end users. If say for example the wallet was to say, okay, we're going to support both of them, you'd have to like change it in the drop down menu. You'd have to say, oh well, I want Sassel.eth on the original ENS, or I want Sassel.eth on the forked one. So from that perspective, it kind of like makes it so that these wallet interfaces don't want to support a forked version, because it just gets messy from there. It would be very messy for the end user, because the end user probably wouldn't want to click through again, want to have to check these things. They'd get confused by the fact that there's multiple multiple different versions going on. So I think a forked version of ENS wouldn't take off at all. I don't think anyone would support it. So yeah, hopefully that answers your question there. All right, one here from Dom who asks, does Aave V3's portal thing mean I could bite the bullet today and deposit my ETH bag on Aave mainnet, and then in the future borrow stablecoins against it, but receive the stablecoins on Polygon, Arbitrum, Optimism as soon as Aave deploys there? Would there be L1 fees involved for using that portal? As far as I know, yes, because I think this is how the current version of the portal is going to work, is that you'll be able to take your A tokens across chain and kind of like do things on different chains using your A tokens. I need to dive deeper into it. I don't know if there's more details about how the portal is going to work just yet. But essentially, you would still have to pay L1 fees, I believe. I don't think there's going to be a thing where you can have funds on Aave V3 on layer 1, and then Polygon or Arbitrum Optimism reads from that and kind of like lets you borrow an L2, unless they implement it themselves as well. I think that might be one of the features and one of the end goals for the portal, kind of like the feature. But I think as it currently stands, it's just for transferring A tokens across different layers at this point in time. But I wouldn't be surprised to see them do this feature where you can tap into and read state from different kind of like chains. It probably would only work for L2. Sidechains get murky, because if you start reading state from L2 from side chains, you're having like different security assumptions, whereas with L2s you're not, because the state is kind of like shared between Ethereum L1 and L2, and it's all secured by Ethereum L1. So I think that they may do that for the L2s, but I'm not sure if they do that for the side chains. It definitely becomes a bigger security risk doing it like that. So hopefully that answers your question. But I should dig deeper into the portal kind of like feature and see if they've added more information about that. Because when they first announced that, I remember the information wasn't too detailed; it was a bit sparse. So I'll have to just do a bit of a deeper dive there. All right, one here from RV Deeb who asks, a question about MEV and around the rise of MEV on alternative low-fee L1s, including ones branded as MEV resistant. MEV resistant low-fee L1s. We all know how that turned out. Anyway, you ask, how would the Ethereum L2s fight transaction spam from MEV bots once the fees are low enough? Is it something that even needs to be fought against, as the ARBs MEV are pretty much essential to keep everything in check? So there is kind of like different versions of MEV, or different kind of like types of MEV, I should say. There's the quote-unquote good MEV or useful MEV, such as arbitrage, right? Like keeping the prices in check across different liquidity pools on within DeFi. That is good MEV because it's needed, right? But obviously the people doing that, the people doing the arbitrage transactions, are profiting from that. So and if they're doing it through miners or through validators, it technically MEV. That's why people kind of like knock back against Emin, who said that arbitrage wasn't MEV. It is the most kind of like elementary form of MEV, but it is still MEV. Then there's the parasitic MEV, like sandwich attacks and front running. Sandwich attacks are in particular pretty bad, because they essentially force the end user to buy something at a much higher price or potentially at a much higher price than they thought they were going to buy it at. And front running does a similar thing as well. And then there's back running, and then there's time banded attacks. MEV goes deep, like it's pretty wild. So with that context, you ask about like how is MEV going to be treated at L2? This is an open question. I actually do think that L1 MEV is going to eventually either be completely eradicated, or at least flow back to ETH holders, because post merge, validators obviously are ETH holders because they have to stake 32 ETH, and all the MEV are going to be going to validators. So it would flow back to them, which I guess is a lot more symbiotic than what it is now. But at the same time, once L1 Ethereum literally just becomes a chain that only validates proofs and data from L2s, As far as I know, there wouldn't actually be any MEV to extract because there's no MEV to be done on proofs or on core data because it's just storing these things on chain. There's nothing to front run. There is nothing to sandwich attack. As far as I know, maybe I'm wrong here, but I've asked this question to a few people and they haven't been able to kind of like break my assumptions here. So my assumption is that L1 MEV eventually will go away completely as a consequence of L2's filling up L1 with proofs and call data, which is really cool. But then you push the MEV to L2, which is already happening. I mean, any L2 with multiple liquidity pools is going to have MEV on it. And pretty much, I mean, I'm sure it's happening on Arbitrum right now in terms of like being able to arbitrage. But the thing is, Arbitrum are the only one running the sequencer, and I don't think that Arbitrum are going to be doing MEV on their user on any of the users. But it's when they decentralize the sequences, that's when it becomes it becomes more tricky, right? Because the sequences have the ability to order transactions, which means they have the ability to do MEV, but being nasty MEV or just like the normal MEV, but they're still going to be able to do it. So there's been a few different ideas proposed of how to combat this. I know Optimism talked about doing what was called I think it was like auctioning off MEVA, so MEV auctions, where they would essentially auction off the rights to MEV on the chain and then give the auctioned proceeds to public goods. This was controversial because it was people basically said, well, I mean, yeah, okay, the funds are going to public goods, but the MEV is still bad because the MEV is still happening. So I think that would be maybe a short to medium term solution, but the long term solution would be to just try and eradicate as much MEV as possible. And there are different ways you can do this. There are different research kind of like initiatives going on in this area. One of the big ones is Flashbots, which doesn't eradicate MEV, but it democratizes it, which makes it more fair. Again, there is kind of like arguments for and against this as well. People say just because you made MEV more fair doesn't really mean anything for the end user. They're still getting screwed. Yeah, I get that argument, but at the same time, it's better than no democratization. Sorry, I mixed my words there. But I think like in terms of like the L2s having low fees and trying to fight spam, that's another concern. And this is why I don't think fees can be zero. And this is why I actually wasn't surprised when kind of like Solana fell over, because their fees aren't zero, but their fees are like very, very cheap, right? They offer whatever it is, 50k TPS, and their fees are like 0.001 or whatever. Now, because the fees are so cheap, it encourages bots. It encourages a lot of bots. It encourages transaction spamming. And that's exactly what happened when that I think it was like an IDO that went live, and suddenly 400,000 transactions flooded the mempool. Oh, they don't have a mempool, but like flooded the network in Solana, and it caused the validators to go offline, which was effectively a DDoS attack or a DOS attack or a denial of service attack. Now, this exact same thing can happen on any chain that offers basically super low fees or no fees. This is why fees exist in the first place, by the way, or a major reason to prevent against DOS attacks, among other things. So how do you keep fees really low for end users, but also fight against spam and kind of like related kind of like malicious things on L2? The way Solana has done it is that they're doing what's called QoS, or quality of service, where they've got some system in place, or they plan to put some system in place, which drops transactions that they consider to be spam. I don't think this is a good solution, especially not for layer one. I think that it's basically censorship, because you will always going to have false positives in that. Just like you sometimes have false positives in Web 2. Web 2 deals with spam, by the way, by doing QoS as well. There are providers for this, such as Cloudflare, DDoS protection providers, that basically drop packets of information from IPs that they consider to be potential spam or potential bot activity or potential DOS activity. Now, that's okay for Web 2, because if for some reason you are flagged as a kind of like a bot, or you're flagged as someone trying to DDoS the website, then you can just kind of refresh and that problem usually goes away, or you just wait a little bit and it's okay. But I mean, you don't really expect Web 2 to be censorship resistant, right? Or kind of like it's a different kind of set of expectations there. And there's no kind of like money involved or anything like that. It doesn't stop you from kind of like accessing your funds or anything like that. But in kind of like the Web3 world, where you definitely expect to be able to access the chain whenever you want, then it becomes like a very big issue. And dropping random transactions that you suspect are spam, you could end up dropping real user transactions. So I don't think that that is a sustainable solution either at layer 1. It could be at layer 2. It could be a sustainable solution where you have these DOS protection of quality of service, of dropping transactions at layer 2 and all that sort of stuff. But again, in my eyes, it's tantamount to censorship. But if it has to be done at layer 2, it's actually fine, because if, the worst case scenario, you can't do anything at layer 2 because you've been censored, or, your address has been blacklisted or whatever, blacklisted by the QoS system, or whatever happens there, you can always get your funds back out at layer 1. Yes, the fees on layer 1 are probably going to be pretty expensive to get your funds out, but it's better than, in my eyes at least, it's better than not being able to access your funds at all, or not be able to do anything at all on kind of like the L2 or on an L1 that uses QoS to kind of like fight spam and DOS things. So hopefully that gives you an overview of how, I'm thinking about MEV at L1, L2, how I think about spam and all that sort of stuff. It's definitely something that the L2 teams are going to have to think long and hard about, and it's going to be a balance that needs to be struck between, how low the fees are and protecting against spam and DOS. But I do think eventually fees for end users are just going to be zero in the interface, and they're going to be hidden, so to speak, where the fees will be still collected and paid, but the end users will pay them not through quote unquote gas fees, but through trading fees, marketplace fees if they're doing NFT stuff, other sorts of fees that are just like part of using a service. This already happens on Immutable X, by the way. The end user pays zero gas fees, but you pay marketplace fees, you pay minting fees, you pay blah, blah, blah fees, and that goes to Immutable. They pay the gas fees for you, and all's well and dandy. So I think that's what's going to be kind of like the end state for these L2s. Because if we want to scale this to the world, you can't have these extra kind of like in-your-face gas fees in the transaction flow. You have to abstract them away, and the easiest way to do that is to basically have the L2 operators pay it for users, but make up for it in other kind of like ways there. So hopefully that gives you an overview there. So I got a question from the audience from Tob KO. Hopefully I said that right. I'm inviting you up on stage here. Oh, just got to accept my invite there, Tob. Nope. Okay. Maybe he's AFK or something like that. All good. All right. While we're waiting for them, I'll continue through my list here of questions. All right, one here from Yawn the Fawn or Dom? No, I think Dom's first. Yeah, one here from Dom first. I have a few friends who tell me that even if the Web3 utopia happens, the power structure would only shift from shareholders who have the most money to people who have the most coins with regards to what happens to a project and how the value is shifted around, i.e. that nothing would fundamentally truly change and things would still be terrible, just in a slightly different way. I have my own answers to these claims, but would love to hear your thoughts to see if I'm missing anything. So I would love to hear your answers to this if you want to kind of like follow this up in the Discord channel later on. But I guess like my answer is maybe multifaceted here. The first thing I would say is that I think building on a strong, decentralized, and secure base layer is of utmost importance. And I've mentioned this before. Without a strong foundation, everything else built on top tends to fall apart. So, for example, Ethereum Layer 1 is a strong foundation to build on, right? You have relative certainty that it's not going to fall apart, that the network is stewarded by a vast and large worldwide community of thousands, tens of thousands of people who deeply care about the technology. You have a set of developers, core developers otherwise, that deeply care about the Ethereum chain and making sure that it is long-term sustainable and healthy, and you have a general culture of sustainability as well. So you can be very, very certain, or relatively certain compared to other things, that Ethereum Layer 1 is going to stay decentralized and secure, and also Ethereum Layer 1 hasn't got on-chain governance, so there is no people with the most coins being able to mess with the chain. And miners can't really do anything. Stakers won't be able to do much. Ethereum being truly decentralized actually means something when you think about these questions. It means that no one actor or group or party can actually influence the network in kind of like a authoritarian way, right? Just use an example there. There's, for example, even the core devs can't do this. If the core devs put an EIP forward and it was a really shitty EIP, the whole community would come together and say it was a really shitty EIP. Like, they're not going to just say, "Oh yeah, this EIP from these core devs that makes total sense," even though like it's absolutely terrible for the chain. Let me give an example here of a terrible EIP. Let's increase the ETH issuance by 10% a year, right? Let's say for some reason the core devs all agreed to do this, which, I mean, I don't think they would, but let's just entertain this for this example. Let's say they all agreed. Here's this EIP. We're going to increase ETH issuance 10% a year. Our reasoning is that we think that ETH should be much more inflationary, and that's that. Well, you're going to get pushback from pretty much everyone in the Ethereum community because, one, it goes against precedent. Two, it makes zero sense to do this. Three, there is a defined roadmap for ETH issuance. Post-merge, there is an issuance schedule that is variable based on how much ETH is staked. We have the burn to offset that issuance, and everyone in the Ethereum, well, most people in the Ethereum community agree that ETH being a deflationary asset is desirable. So that's an example of something happening where even the core devs can't put in stuff that would adversely affect the network into Ethereum. They'd get pushback on it, and the whole community would rally against them on that. I don't think they'd ever do that, to be honest. But just to say that. But I think it's a good example to illustrate my points. But then on to, I guess, like above Ethereum layer 1, whether that be the apps built on top of it or L2s or anything like that, anything with coin voted governance or coin holder governance. I do think that your friend may have a point with regards to things centralizing around a small group of people, because this is why I've always been very bearish on governance for layer 1s. Is that it will always, in my mind, devolve into a plutocracy, especially if that chain is being run as a depot system or a delegated proof of stake system. I think the default and the incentives all just point towards that chain becoming a plutocracy. But when it comes to the applications built on top, the good thing about the applications is that they're kind of like, I mean, they do talk to each other, but they can be isolated. So, for example, if an app on Ethereum, whether that be a big or small app, was to get like taken over in a hostile takeover, and everyone was trying to enrich themselves, the community would basically come together and fork that off, right? And either fork the project or remove their liquidity from the project or abandon the project really quickly and go to somewhere else. But if this happened on Ethereum layer 1, the only place that they could go to is one of these competing L1 ecosystems, and that's a much harder switching cost. Like, the switching cost from going from Ethereum L1 to another chain is massive, as opposed to going from an app to an app. We saw like little bits of this play out with the Uniswap and SushiSwap stuff, because originally SushiSwap said that they were created because they didn't like that Uniswap raised from VCs. It didn't feel like a community-oriented thing, so they forked off, and then you had all the drama around it. But now Uniswap is still much bigger than SushiSwap because they haven't done anything to adversely affect the running of the protocol yet, right? It could happen in the future, but up until this point, Uniswap has been run really well. They've done major releases like V3, which is, just killing the game. They recently did their 0.01% stablecoin fee pool, which seems to be killing the game as well. So from that perspective, even though there may be like a concentration in the coins and in kind of like the quote unquote shareholders of Uniswap and of governance, one, they're limited in what they can do in Uniswap's case, and two, it seems the community and people in general are fine with with the way they're running things. But if they weren't, they could switch to something else. We have other AMMs out there. People could pull the liquidity from Uniswap, go somewhere else if they wanted to, and it'd all be well and fine there. So I think always splitting up the foundations from what's built on top is critically important, because as I've used the analogy before, if you have a building, you build the foundations, and the foundations need to be the strongest thing of that building, because if they're not, it doesn't matter what you build on top, everything comes crashing down if the foundations break. It doesn't matter how fancy, floor 10 is or how fancy floor 20 is. If the foundation is weak, the whole building comes down together, and there's nothing those floors can do to protect themselves. Whereas on Ethereum, you can have, really good certainty around the fact that Ethereum, as a base layer, is not going to screw over your project. It doesn't have coin holder voting. There's no one that can do a hostile takeover of Ethereum, or at least it's near impossible to do a hostile takeover of Ethereum. or anything like that. And then on the the apps built on top, well, they have to earn that right? Even if they have coin holder voting, they have to kind of like show over time that they're not going to adversely affect their kind of like users of their app through on-chain governance. But at the same time, it's limited, right? The damage is limited if they do that. The damage doesn't spread to everywhere else. There's been multiple examples in DeFi of projects that have had really bad governance or have had really bad teams running the project, and the project falls apart completely. But that doesn't really adversely affect the other kind of projects on the network. It doesn't really affect Ethereum at all. Ethereum keeps chugging. Ethereum as a protocol doesn't actually care what's happening on its network. That's the beautiful thing about Ethereum, is that everything to the Ethereum protocol is the same. As long as it's following the Ethereum protocol specification and the rules, the Ethereum protocol doesn't care what you're doing on it. So if a project fails, Ethereum says nothing. It doesn't even notice that a project failed. It just keeps producing blocks every 13 seconds. And there's nothing that anyone can do to change that unless the whole community came together to change the base layer. But that's why having a fundamentally strong base layer is so important, so that these apps can be built on top. They can experiment. They can have these on-chain governance things. And if they fail, it's okay. Let's just move on to the next thing. And with DeFi, things are obviously more interconnected, and something as big as Uniswap or Maker DAO failing would send kind of like ripple effects across the ecosystem. But the thing is, Ethereum would still be able to recover from this because the Ethereum network, as I said, would still keep chugging. It would just require the app layer to kind of like navigate around this, and we can, because everything's transparent. We can see everything that's happening. No one can do things behind closed doors, because to do anything, you have to do it on chain where everything's transparent. So that's another kind of like key aspect to it as well, where in companies, in centralized companies, you can't really see what's going on, like, most of the time at all. Like, you can't see what changes are being made. Usually you have to wait till like the quarterly reports to see things as a shareholder. Whereas on Ethereum, there's no such thing as a quarterly report. There's a every second report or every millisecond. Like, you can always look at the chain. You can always check the chain. You can always see what's going on at 24/7. So that radical transparency just adds another layer on top that allows you to basically have better guarantees around things, even though there may be concentration of coins, for different various DeFi apps using on-chain governance. But I think that only works at the app layer. The base layer doesn't work for, because if the base layer is centralized, if it turns into a plutocracy, then you have very little wiggle room there, because essentially the base layer affects everything else built on top of it, and that everything else, it has to either migrate off of the base layer, which can be very painful to do that, to another base layer, and build up a network effects there, and maybe compete with other projects there, or they could run the risk of something bad happening to their app, because the runners of the layer 1 chain want to do something to that app, something malicious to it. So and then the chain doesn't become credibly neutral anymore, which is something that I've written about in the past as well. So maybe that's a long-winded answer, but hopefully that answers your question there, Dom. I'm going to take a quick drink break. One sec, guys. All right, on to the next question from Yorn the Fawn, who asks, just for fun, say you fall into a wormhole and get spit out in January 2023. You go to check CoinMarketCap. What do you see in the top 10, and in roughly what order? This is a really fun question, because if I'm being honest, every time I've tried to predict what the top 10 is going to look like, it has completely failed. I don't think anyone can predict what the top 10 is going to look like, simply because the top 10 is like, I've thought about this a lot. The top 10 for me is like this zone of like memes. That's what it is. Because if you look at the top 10 over the years and how it's changed, what gets in there a lot of the time has to do with like memes and attention. We had Dogecoin in there. We had SHIB in there. We had Cardano at number 3. It's now number 6. That was all memes, right? And then they launched smart contracts, and people realized that Cardano actually wasn't going to kill Ethereum. I guess like most people knew this already, but there was kind of like the fanboys. And then you had like other things going there, like Litecoin was in there for a while. Litecoin is now 16. I'm just looking at the list here on my screen. And then Solana wasn't in there until recently. You have stable coins in there. I mean, if you remove the stable coins, XRP was at number 3. Now it's number 7. If you had told me that XRP would still be in the top 10 in November 2021, I would have called you crazy. But here we are, right? It's there. If you told me that Cardano would get to number 3, would have called you crazy. You just look at these sorts of things. It's just like, it's really insane. Dogecoin and SHIB. If you told me they'd be in the top 10, I would have called you crazy. So I just don't have any predictions around this, except that I believe, maybe I regret saying this, but I believe that there's a high chance ETH will be number 1 in January 2023 and Bitcoin will be number 2 or lower than number 2. Maybe that's controversial for me to say. Maybe not for this crowd, but in general, maybe it is. But I think that ETH has a shot at flipping BTC before the merge. Now, whether this is a temporary flip or a permanent flip is another thing. It's probably going to be temporary to start because of just the way the markets work. It's going to be a big deal when it happens, of course. But in terms of like long term, I mean, the merge, if you say the merge happens in June 2022, then there's still another like 6-7 months for ETH to get back to number 1 if it falls. But it depends on what the market's doing. Like, are we in a bear market then? It's kind of really hard to tell. But that's the only thing I could really say with relative certainty. The rest of it, top 10 could look completely different to what it is right now. I actually thought, like, at the beginning of this year, that the top 10, top 20 would consist mainly of DeFi tokens by the end of this year. That was one of my predictions. I got that wildly wrong because DeFi tokens have actually been one of the worst performers of this year. Most of them, at least. Some of them have done well, but, the 1.0, quote-unquote 1.0 tokens that people like to talk about, they have done really poorly, especially against ETH. I didn't see that coming. I thought that would actually do very well. And another thing I didn't see coming was like the L1s pumping. And in hindsight, I should have seen this coming because of the high fees, but I didn't realize how aggressive these L1s would be with their liquidity mining programs and their incentive programs. So, as I said, like, it's just too hard to tell what's going to happen with the top 10, top 20, top 30, top whatever. So I don't really have any predictions there, but I do think with relative certainty that ETH will be number 1 by January 2023. As I said, I do think it's going to happen before that, leading up to the merge. I mean, if ETH was going to flip Bitcoin at any time in its history, it would be leading up to the merge because we have that massive issuer introduction coming. We have ETH finally going to proof of stake, which has been a long time coming, and there's a very, very strong narrative around that. And if you look at the ETH Bitcoin ratio right now, the charts, just from a pure kind of technical perspective, is extremely strong. I mean, ETH usually bleeds against Bitcoin in Q4, and it's done that for the last 6 years. Didn't do it this year. That's a huge precedent break there. And you're seeing the narrative shift right now. I mean, if you go on Twitter, go follow some traders, they're talking about this as well. It's just been in a constant uptrend. And I think that's a lot due to the fact that Ethereum has grown, so rapidly. We have EIP 1559 in place. The scaling roadmap is coming to view, and people are like, well, okay, Ethereum is actually going to scale. It has solutions live today, and there's more coming. And everyone's talking about ZK stuff now and roll ups in general. So, as I said, I that's the only thing I can predict is that, well, I can hope to predict is that I think that ETH will flip Bitcoin before January 2023, and may even be number 1 in January 2023 as well as a permanent flip there. All right, on to one here from 0x Boomer, who asks, will optimistic rollups become extinct if ZK tech really flourishes? It feels like all of the optimistic rollup L2s will be obsolete once ZK tech is generally available. If so, does that mean Arbitrum, Optimism, etc. are gone, or do they migrate to generalized ZK rollup technology? So I think over the long term, the consensus that I've seen, at least from most people, is that optimistic rollups will be obsolete eventually, right? When we get those kind of like ZK EVMs and we have them like on par with what optimistic rollups can do today, we've battle tested them, they're safer and secure, then yes, I do believe that ZK tech is going to eat everything. In saying that, there is still a lot of risks with ZK tech right now. Very untested. The cryptography is very new. There's a lot of weird and wacky shit going on that people, a lot of people look at and like, oh, how does this work? I don't understand how this works because this is very new tech. So I would say that optimistic rollups are going to be with us for a few years at least in terms of like availability and being used by different projects. And the thing is, optimistic rollups are very early still as well. So if optimistic rollups are early, I would say ZK tech is still very, very early. And there is a lot of hype for it, but I think the hype underestimates how kind of like difficult it is to do EVM stuff with this new technology because of the fact that it's so new that there's not really... To do EVM equivalents with ZK requires a lot more work than to do EVM equivalents with optimistic rollups. So I think that optimistic rollups work as like the next stage in the scaling journey for Ethereum. First, we had side chains like the Polygon POS chain, which, I mean, the Polygon POS chain is hard to classify. It's not, it's not technically a side chain, but it acts like a side chain, but it has other security guarantees. But in terms of like just EVM side chains in general, those have been kind of like, went from ETH L1 to EVM side chains. Now it's swung back to rollups. And I think that optimistic rollups are what it's going to mostly swing back to because they're ready now. You can deploy apps there, you can use them, you can have the same experience as L1 with cheaper fees. And as we progress through them, they're going to get even cheaper to use than they are right now. I know they're still a bit expensive, $4 or $5 for a swap. We can hopefully get that down to under $1 pretty quickly over the next maybe 2-3 months, depending on if call data compression is enabled and if this EIP goes through to reduce rollup costs by 5 times on L1. But if we're talking like, maybe 2 years, maybe it could be less than 2 years, I don't know. But if we're talking about like 2 years out or something like that, 2-3 years out, I would be very surprised if ZK wasn't dominating everything at that point. And in that kind of like context, I would be very surprised if Arbitrum and Optimism haven't also had ZK technology developed and put out into the wild as well. So yeah, I don't think, just to summarize, optimistic rollups here to stay for the foreseeable future. Don't think they're going to be obsoleted as quickly as people think they are. I think they serve a very good kind of like need right now. I think they work right now. They work to scale Ethereum right now. There's a lot of smart people working on them. And I think the drawbacks that people talk about are vastly overstated at this point, because the 7-day withdrawal period, for a long time, people were like, oh, this is kind of like a deal breaker. Now we have like, I don't know how many bridges. There's like 10 of them at this point where you can go from an L2 to an L1. We have Arbitrum integration coming with, Binance integrating Arbitrum. And that became like a non-issue, right? So looking at it from that perspective, in that context, optimistic rollups are not obsolete yet. Probably will be eventually, but not for at least a couple of years, I believe. And that's going to give us another kind of like stepping stone to getting to the ultimate final boss, or I guess like not boss, but like final form, which is ZK tech. And the way I kind of like think about it is, if Ethereum L1 is like a 56k modem, and if optimistic rollups are kind of like maybe Ethereum L1 is like dial up, and optimistic rollups are like broadband, then ZK is like fiber. So that's kind of like how I think about it in my head as a progression. Maybe Cardano is 56k modem, since they can only do one transaction per block. But yeah, that's kind of like how I think about the scaling journey that Ethereum is currently going under. And ETH L1 feeds into all of this, of course, like sharding. People might be wondering about it. Sharding just works to enhance rollups. It works for both optimistic and ZK rollups. It doesn't matter which one they are. So that's all part of it. And same with like any changes on L1. It's all just to support the L2 ecosystem. So yeah, hopefully that covers your question there, 0x Boomer. All right, one here from Yorn the Fawn. Thoughts on Shell Protocol? Anything in particular that makes it special? So I heard about Shell Protocol a while ago. For those who don't know what this is, it seems to be a kind of like a stablecoin aggregator, swapper, kind of like similar to Curve. I haven't looked into it recently. I know they were working on a V2. I don't know if that's live or anything, but yeah, I haven't checked in on it recently, so I don't really have much color to add here of what makes it special or anything like that. But if anyone else does, if anyone else has looked into Shell Protocol, you can post about it in the DeFi channel if you want to talk about it there. But yeah, sorry, I haven't really looked into it lately. All right, one here from Kushim, who asks, Rocket Pool finished their launch on November 22nd. If you had 20 ETH but did not want to deal with the hardware side of running a node, would it be better for the network to use all nodes, SaaS, or software as a service to run your node, or B, simply stake 16 ETH to the protocol and receive rETH in your wallet? Interested to hear your thoughts on this. I don't actually know what all nodes SAS is. I'm assuming it's some kind of like service provider for running a node, maybe similar to something like dApp node. Or kind of like maybe something centralized. I haven't heard of it before, sorry. But I would say that staking 16 ETH with Rocket Pool would probably be the better choice here, because, I mean, Rocket Pool is trying to build and is building a decentralized staking network on top of Ethereum, right? So that people can stake with less than 32 ETH, of course. And from that kind of like vein, I would say that it's better to kind of like put your ETH in there, grow the Rocket Pool network, because it actually directly contributes to the decentralization of kind of like the beacon chain. So, but as I said, I don't know much about all nodes. I don't know anything about all nodes. So I don't know what I'm comparing Rocket Pool here to, but generally, Rocket Pool is definitely a very, very good solution for staking with less than 32 ETH. All right, one here or two more here from you on the phone who asked, you were talking about Uniswap's low fee stablecoin swap feature and mentioned that it had resulted in high trading volume. What does trading volume mean exactly? If you do a swap of one USDC for one DAI, does that transaction amount to a trading volume of $2? This is an interesting question because I've never thought about this before. But I'm going to assume it accounts for a trading volume of $2, right? Because it's a swap between the $2, right? It's a swap between two stable coins, one and one. But I don't know actually. Maybe I'm wrong there. I should know the answer to this question, by the way. I've just never thought about it in this context before. Yeah, I mean, I assume that it would be like a trading volume of $2. Maybe I'm going to sound like a complete noob here by giving that answer, but yeah, I should definitely kind of like look into that. Or maybe I'm brain farting. But yeah, unfortunately, I don't know exactly how that's kind of like counted because there are concerns about like wash trading and things like that, and being able to fake volumes because you just like trade between yourself or trade between someone else and just like keep trading the same thing in order to fake volumes. There are some ways to mitigate that, or some things that mitigate that, such as like the trading fees on Uniswap or the gas fees and stuff like that. But in terms of like counting the trading volume, I'm going to assume that I'm pretty confident that it would count it as kind of like $2 because it's like one USDC being traded for one DAI, equals two. So I'm going to assume that. But if I'm wrong, then I have egg on my face. I'll admit that I'll take the L there. But yeah, that's my kind of answer there. All right, next question you had was, next year seems like the perfect storm of events to make 2022 the year of Ethereum. In particular, a successful merge combined with L2 deployments, which should both simultaneously make ETH become low in supply, burned plus staked plus DeFi locked ETH, and high in demand. L2s enable low fees so that anyone can play on the network. Is it just me, or do you also feel like 2022 is going to be bananas for Ethereum? Not just you, my friend. I have been saying this for quite a while. I think, as I've been saying for a while, I think 2022 is shaping up to be an absolutely amazing year for Ethereum because, as you mentioned, we're going to have the merge, we're going to have L2 deployments really ramp up. There's definitely going to be token incentives on these L2s, 100%. Like, I have no doubt in my mind about that all of the L2s are going to have tokens within 6 months. I'll put money on that. But and DeFi continuing to keep growing, NFTs continuing to keep growing, the merge leading to ETH becoming net deflationary all the time, massive issue introduction, moving to proof of stake finally after 6 or 7 years of being in research and development. And there's other upgrades that may be coming in 2022 as well, such as that EIP to lower gas fees for roll-ups on L1. That's huge, by the way. Like that 5 times that's an immediate 5 times increase in scalability for roll-ups, as I mentioned on the refuel. So yeah, we really are. I've said this so many times, guys. We're at the golden age of Ethereum. If there was any period of Ethereum's life cycle to be in, to experience like all of it and to experience the best things Ethereum is going to have to offer, it's right now. Obviously, if you were earlier on, you could have been there at the very beginning, and that was fun. That was obviously that was obviously very profitable. If you were there in 2019 buying ETH, you're kind of like in a very good position right now. But I think that we're really just getting to the point. As I said, we're going from like the dial-up era to broadband with optimistic roll-ups, and then going to fiber with ZK stuff. But I do think that maybe the analogy doesn't work one-to-one. I do think that for most users, going from L1 to L2 will feel like a fiber experience even with optimistic rollups because L1 is just so stupidly expensive, right? Like I've been doing some trades lately and a bunch of other stuff, and I'm spending so much gas on L1, and I mean I'm less sensitive to it just because of the position that I'm in, but at the same time, even for me, I'm looking at it right now and I'm like, that's like ETH, right? That's not like a stable coin that I'm paying. That's ETH, and what I do is I actually replenish my ETH every time I use it for gas fees. I buy it back on an exchange, but like I'm looking at that and I'm just like, like it's so expensive. So I think L2s are just like such a big deal in of itself. But then you have all this other stuff happening in Ethereum as well. So yeah, definitely agree with you that 2022 is going to be an absolutely amazing year for Ethereum. It could be even more amazing than we even know because there are things that we probably can't even see that it's going to happen, right? Like, for example, I didn't see NFTs blowing up as much as they did this year. I don't think anyone saw that happening. Maybe 2022 is the year of the DAOs, and we have like so many DAOs everywhere. People are, speculating here, speculating there. Normies getting involved in DAOs. This stuff happens. There's airdrops everywhere. I mean, there's been airdrops everywhere this year, but like more airdrops, more money. Who knows, right? Maybe NFTs have another kind of like go at it, and we have like different NFTs that get popular. Maybe the art NFTs get really popular this time or something, or maybe there's a use case that comes along that we haven't even thought of yet. There's all this stuff that could happen, but if you just look at the stuff that we can actually see coming and we see happening, it's already amazing. So the fact that we have all of that stuff that we know about, and then all of the stuff that we don't know about that could happen in 2022, which, let's be honest, because there's so much experimentation going on Ethereum all the time, we're bound to see really, really cool stuff happen in 2022, and even beyond that, of course. I do truly believe that Ethereum in 2022 is going to be amazing, and I'm obviously going to be covering it every weekday on the Refuel, and I can't wait to see what happens in 2022. But yeah, I mean, it's funny that I'm talking about 2022 as if it's something that's kind of like in the distance. It's kind of like really close, right? It's a month and a bit left of this year. Christmas came around quickly. I was actually thinking about that today. I was thinking about, wow, I have to put the Christmas tree up soon. So yeah. Anyway, that was a little bit of a tangent there. Yeah, definitely share your kind of like excitement, Yawn. All right, one here from Tim J. Robinson, who asks, I've heard you mention that when the merge happens, the APY for ETH2 node runners will go up. Do you have any details on what it will change to post-merge? So it's hard to tell exactly what it's going to be post-merge, but you can do some napkin math. Take the fees that aren't being burned right now, so the fees that are being paid to miners, calculate that, annualize that, then annualize that return for validators, and then you'll get the APY boost. Justin Drake has a spreadsheet for this, I believe. It might be on his Twitter somewhere, so if you want to kind of find that spreadsheet, you can go to his Twitter to find it, but that's how you would get the APY. The estimations from, I think, a few months ago was over 10% APY, and that would mean that like it'd be 5% from the block rewards, 5% from the fees. But it's variable because fees obviously vary greatly throughout the year. So annualizing fee revenue for Ethereum is kind of hard because, we had like less than 10 Gwei transactions in June. And then since like August, we've had like 100 plus consistent Gwei transactions. So like a 10 times increase. So it's very hard to annualize out fees. So it's very hard to kind of like know exactly what the APY is going to be on an annual, for the whole year. It's going to be variable, of course, because of the fee revenue. But I would say that you can do like napkin math and just take a period of the year, say take like a 3-month period, average that out, and then annualize it, and you can get like a rough estimate of what the APY will be post-merge there. And then you had a second follow-up question. Do you know if anyone has studied the possibility and mitigation of miners performing reorg attacks against Ethereum in a few days before the merge? As they have little incentive to act honestly, they could try malicious tactics. If they do something malicious, can the ETH2 nodes that take over validation do anything about it, or is the chain finalized on the merge switch over block? So this has been thought about a lot, and actually this is one of the main things that the researchers and the client implementers have been thinking about with regards to the merge. The solution presented itself as the merge block happens at a certain kind of like difficulty height. So there's no block number from kind of like from the current spec, from what I know. It's basically do the merge once this difficulty reaches a certain height. I mean, I can't remember the exact details, but this was a direct result of them realizing that, yes, there's kind of like bad incentives for miners, especially in the final hours leading up to the merge, or at least the final days or weeks leading up to the merge, for them to play games. I have talked about this before on the Refuel, I think, but I basically said that I don't believe that miners are going to play these games regardless, because miners have known about this for a long time. All the big industrial miners are definitely preparing for this already, whether that's hedging their exposure with their kind of like mining equipment, or stacking as much ETH as they can to be stakers, and a lot of them already are stakers. So for them to screw the merge would be screwing themselves a lot of the time as well. So I just don't see any kind of attack happening, but obviously you always have to kind of like be prepared just in case something does, and that's why they've come to this conclusion of, instead of doing it at a block number where everyone knows when it would happen, you do it with like a target difficulty rate or mining difficulty rate, and then it can kind of be like pseudo randomized. I may be butchering the explanation there about that. There are more details about that. If you go to like the merge details on the GitHub, for the Ethereum GitHub, you can just Google it, and you'll be able to find some more details about that. So, and then I guess like your follow-up question after that was, if they do something malicious, can the ETH2 nodes that take over validation do anything about it, or is the chain finalized on the merge switchover block? I don't think the chain's finalized on the merge switchover block, because finalization takes 12 minutes. Oh, 30 minutes? No, so 12 minutes, 12 minutes. So it would have to wait until kind of like that happens there. But again, some of this stuff is in flux, so it may be worth checking out the repo and checking out the supporting documentation around the merge to see what the current kind of like thinking is around this from the researchers themselves. All right, next question. Another one from You on the Fawn. Question about token voting. Currently, the general model is to weight voting power proportional to the amount of tokens owned, which concentrates voting power in the hands of the wealthy and creates dysfunctional scenarios such as the one that played out in the recent liquidity mining on Uniswap proposal. Wouldn't it be more democratic to have voting power be one address, one vote, with some thresholds to be able to vote, e.g., holding some minimum amount of the governance token? So, the reason why it's not done like this is because every Ethereum address is anonymous or pseudonymous. You don't know. Anyone can spin up as many Ethereum addresses as they want, and they can act in any which way they want, and you have no idea who that is because there's no KYC, there's nothing to identify them or anything like that. That's why it's kind of like gone towards coin holder voting, because that way you have like an on-chain verifiable proof of what they're doing, right? Like, what they hold and kind of like their voting power. I agree with you. It is not a great system. It's plutocratic. It's kind of like really shitty. As you mentioned, that Uniswap liquidity mining proposal example, that was a shitty outcome. But to do the one address, one vote thing, you would have to have a way to tag addresses and to make sure that it's done in a Sybil resistant way. The only way to do this in a way that kind of like ensures as much Sybil resistance as possible is to ID the address in some way. Now, there are things like that Gitcoin has been running, like proof of humanity. There's a bunch of other things on there to verify yourself. There's kind of like taking the activity that the address has done over time. Maybe POAPs that they're holding, I should say. Sorry. Stuff like that, in order to identify an address and to make sure that address is kind of like unique or a unique person without kind of like directly identifying that person. That presents its own challenges. Obviously, it's less scalable. It's kind of like hard to get everyone involved. It can be exclusionary. So, that's why we've still kind of like defaulted to this kind of like coin holder voting thing. And then you say, can we do other thresholds like holding some minimum amount of the governance token? No, because if someone has like 10,000 tokens, they can just split the tokens up into like 100 different addresses. If you have like a minimum of 10, if you have a minimum of 100 tokens per address, then they can just split up those 100 tokens from that 10,000 into 100 different addresses. So that doesn't work either. But Sybil resistance is a very, very hard problem, by the way. This isn't just a problem for crypto. This is a problem for like online in general, because you don't really, you don't know the person's identity. You don't know an IP address's identity unless you kind of like go through regular law channels. But that's kind of like a whole process, law enforcement channels and stuff like that. So you can't, you can't really even do that with Ethereum addresses. So yeah, it's something that's being worked on for sure. But hopefully that gives you a kind of like overview of the state of that. All right, one here from Fran who asks, can you explain why certain dApps only work with certain wallets? Most everything accepts MetaMask, but other wallets sometimes won't connect to a particular dApp. As far as I know, I'm not a developer here. As far as I know, the wallet has to add support for that app, or the app has to add support for that wallet on their kind of like interface. This is why things like Wallet Connect are pretty popular, because Wallet Connect is basically a standard where if a website supports, or a Web3 website or a DeFi app or whatever supports Wallet Connect, then any other apps that support Wallet Connect can interact with it. So that's why people are encouraging the apps to just integrate Wallet Connect, because then you don't have to worry about doing a kind of like wallet by wallet basis of integrations there. But as far as I know, every interface has to integrate a certain wallet so that it will work with their dApp. All right, one here from Looking Handsome who says, "Hey Anthony, follow-up question regarding rETH. What's the downside of stacking rETH on Arbitrum? My assumption, DCAing Australian dollars into crypto.com to stack rETH via the Arbitrum withdrawal gives you exposure to ETH appreciation plus 4% interest. Is this a viable alternative to services like Celsius for those who can't afford to stake with Rocket Pool on mainnet?" Yes, definitely a viable alternative. I would say the only downside is the fact that Arbitrum is more risky to use than Ethereum Layer 1 because it's newer, it's still got admin keys and centralization vectors, stuff like that. But generally, yeah, I don't think there's much downside there. There's, as I said, there's just the risk aspect to it. Earning a nice 4% interest on ETH is great, right? Like, and kind of like holding rETH to do that is great. And that's the whole point of Rocket Pool, to give users exposure to staked ETH without having to kind of like stake ETH, just being able to hold a token. So yeah, I can't see any kind of like any downsides besides some added risk there, which obviously comes with everything that you use on chain. There's always risks everywhere. So as long as you understand that, then yeah, you should be fine. All right, one here from Brian Peace, who asks, "Congrats on the 1 year anniversary of the Daily Gwei. Regarding validiums, what's the point of posting proofs on-chain if core data is kept off-chain? If access to the core data is lost or censored, aren't the proofs basically worthless? In which case, why not just store everything off-chain?" So no. So the reason why this isn't useless is because validium isn't the final form of off-chain data. Volition is. And what the volition will enable you to do is to either run in validium mode or in roll-up mode, or store your data wherever you want to store it. So for example, the proofs are still posted on-chain under a volition model, but say you want to store the data yourself. You want to put it on your own computer and you'll be responsible for your own data. But say for some reason you kind of like lose the data and you have to kind of like get it back at some point in the future somehow. Say you've lost it because you've accidentally deleted it and you're doing some data recovery, but that takes some time. Well, the thing is that just because the data is lost doesn't mean that the proofs are worthless, because without the proofs being on chain, you wouldn't be able to get get kind of like your funds back no matter what, even if you were able to retrieve that data. But even in that kind of like aspect as well, imagine that you've kind of like put your data on a data availability committee and they go offline and they run away with your data. But say someone else comes along and says, "Well, hey, like I actually had this data. I was acting as a backup. You can download it from me if you just go to this kind of like, you have this torrent and you just download it like in a peer-to-peer fashion. Then you get your data. Well, you have the data. Now the proofs are on chain. So you can just present the data to the chain and everything will be all well and good and you'll be able to unlock your funds." So I don't think it's worthless to have the proofs on chain at all. I think it's very necessary because and I don't think you can store the proofs off chain, by the way, because for the proofs you actually need the chain to come to consensus on it. So it's actually impossible to have the proofs on chain from what I know. I may have to double check on that. Maybe Paulina knows the answer, but I'm pretty certain that you actually can't have proofs on chain to begin with. But as I said, like the other stuff still applies. Where even if you could, it's just it's not, it doesn't make sense to do that, and it doesn't make it worthless. The proofs don't become worthless just because you lose data. You lose access to that data, because you can always gain access to that data back, and then you have guarantees that the proofs are still there on layer 1 Ethereum, because for them to be lost on layer 1 Ethereum, the Ethereum chain would either have to go offline or get attacked to delete those proofs, which, it's very obviously near impossible for that stuff to happen. So yeah, hopefully that answers your question. But I think like the crux of the answer is that like the proofs, as far as I know, can't actually be off chain. They have to be on chain, because the proofs are what the validators or miners or whatever come to consensus on when building the blocks and everything like that and securing things. And you had a follow-up question here, Brian, or another question regarding Vitalik's suggestion to reduce gas costs for rollouts posting their proofs. Why not reduce gas costs for other transaction types too? Could we reduce the gas required for sending funds from L1 to L2? So Vitalik's proposal is to reduce a specific type of kind of like opcode, being the call data opcode, as far as I understand it. This is very specific to rollups because rollups use call data. I don't know if other kind of like smart contracts use it, but rollups use it heavily. I mean, all rollups use it. It's basically critical to their operation. And then, and then that's kind of like why the way it is. But in terms of other transaction types, if you reduce the gas required for sending funds from L1 to L2, you can't actually do this, because The chain doesn't know that you're sending funds from L1 to L2. The chain just sees that you're sending funds to a smart contract. So if you change the cost of sending funds to a smart contract, you change it for every smart contract, right? And you change it for like literally every contract that's ever been kind of like deployed on kind of like on Ethereum. So that actually wouldn't help, because it would actually just it wouldn't just apply to L2s, it would apply to everything. So that's why you can't do it there. I'm sure there are some opcodes that can be maybe fine-tuned to allow cheaper sending. I mean, I actually think ETH costing 21,000 gas to send is probably too expensive, but at the same time, ETH is the kind of like, it sends is one of the most active kind of like activities on the Ethereum network, and gas costs are pretty much in place to make sure that the chain in place for various different things, but mostly to make sure the chain state doesn't bloat too hard, or like that too big of transactions can't like push the network over or can't DOS the network. So there is kind of like a reasoning around this. But yeah, it wouldn't be possible to reduce the gas cost of sending funds from L1 to L2, because sending to L2 is just sending it to a smart contract. And to Ethereum, the smart contracts are all the same in terms of like how they're supposed to act based on their opcodes. All right, last one on the sheet here from Handasa Tech, who says, explain like I'm 5 MEV. Oh, explain like I'm 5 MEV. That's, I mean, I can explain like MEV like you're 30, but like you're 5? Let me quickly think of something. If I was explaining MEV to a 5-year-old, if you want the literal kind of explanation to a 5-year-old, I would maybe explain it in such a way where, imagine you're buying, imagine there's an ice cream truck in your street, and they only have like 5 ice cream cones left, or ice creams left before they sell out. Now, imagine there's a line of 5 people and they're all going to go buy the ice cream cone, right? But then a 6th person shows up. Well, there's only 5 ice creams, there's 6 people. So what does the 6th person do? Well, they cut the line, they buy an ice cream, and then the other 4 people buy their ice cream, but the 5th person doesn't get one. But then that 6th person comes along and says, hey, I'll give you an ice cream, but they'll sell it to you at like a 10% markup. That is an example of front running, where the 6th person front ran, the kind of like last person in the line there. Well, technically they would front run the first person in the line, but let's just, for the sake of the argument, say they front ran the last person in the line, and the last person ends up having to pay higher for their ice cream than they otherwise would have, because they got front run by the 6th person. So that is my best explain like I'm 5 MEV, like on the spot there. Hopefully that makes sense, but MEV, so that explains front running, which is just an elementary part of MEV. MEV, standing for minor extractable value, is literally just like any value that can be extracted by the miner or the staker or kind of like the sequencer or anyone producing blocks, ordering transactions. Now, this is going like, this is not going to be explained like I'm 5 anymore, because I don't have something prepared to explain like I'm 5. But essentially, that's what MEV is. So you can have like any type of MEV, whether it be like back running, sandwich attacks, and front running, or time banded attacks as well. Which is time banded attacks are basically got to do with reorgs, where essentially miners can like reorg each other and then reorg each other again, and it's kind of like the chain seems to be doing kind of like time travel, so to speak. It gets really messy and it's really cool when you think about it, but this sort of stuff can happen, but there's like different incentives that are preventing it from happening. But I can't begin to explain like I'm 5 that. Maybe not even explain like I'm 30, because I'm not an MEV expert, but yeah, hopefully that kind of like explained it as well as I could on the spot. All right, I think there's a bunch more questions in the AMA series channel I'll get to now. So one here from Parkerbo, who asks, what would be the TPS on ETH2 proof of stake without the rollups and sharding? The same as it is today. A proof of stake doesn't increase scalability at all. And there's no kind of like TPS increase on layer 1 Ethereum with the merge, which is the proof of stake kind of like merge there. And without rollups and sharding, yeah, it'd be the exact same as it is today on layer 1. One here from Crumpy. With something like Polygon having multiple scaling solutions, what is the process of all these dApps already on the POS chain moving over to Polygon future ZK rollups? Is this a smooth and easy transition, or is this a burden in any way? they would just basically have to redeploy to these future ZK rollups, just like they have to redeploy to other ecosystems. There's not really a simple way to yank your app and all the liquidity. I mean, there isn't really a way to do this at all, to yank your app and all your liquidity from one chain and put it on another. Obviously, that is a very centralizing thing too, so that obviously is not something that the teams want to do either, even if they have the ability to do so through an admin key. So yeah, it's basically just like migrating across. One here from G4D GMI. I want to get your opinion regarding I can't seem to understand how they get the insane APY. I won't give my opinion on because like it's a controversial thing where some people think it's a Ponzi, some people think it's not. The reason why they can get that insane APY is because they do it's not rebalancing. It's oh man, what's the thing called? The word's escaping me right now. Rebasing, that's what it's called, because they do rebasing where they have like a target price that they want to get to, and they rebase every so often to get to that target price, and by rebasing they give everyone else more tokens than what they had, and that feeds into the APY. But on top of that, they also kind of get the APY fed in from the trading fees, because they do what's called protocol owned liquidity, where they buy their own liquidity shares and then like manage it themselves, and the APY, as far as I know, from the trading fees goes to the stakers. But I think most of it comes from the rebasing. So hopefully that answers your question. The insane APY is actually like there's a lot of risk attached there, because what can end up happening is that these rebasing coins can death spiral, where people will sell them and then the price will dump and then it'll rebase and then people will sell it again and rebase and sell it again. You know what I mean? Like it can death spiral, but it attempted to death spiral a few weeks ago, but then it kind of like bounced back. But a lot of smart people think it's just going to eventually hit a point where it just death spirals completely. I'm not convinced of that yet, but I'm not going to give my opinion on if I think it's a Ponzi or not. That's up to the general viewer to decide that. One here from Jimma888 is WAGMI or we going to make it legit or just marketing? What does making it look like? I think making it for most people looks like making enough money in order not to work a normal kind of like full-time 9 to 5 or quote unquote wage cut job anymore. I think that's what making it was for me. And not just financially, but also a lot of people, it's also like kind of like socially and professionally. So what I mean by that is having a career that they enjoy doing, that allows them to kind of like keep advancing and progressing, getting better at what they do, grow their own kind of like social capital, grow their own community. A lot of people have done this. I mean, speaking from personal experience here, I'm pretty, like at this point in time, I'm pretty comfortable saying that I've done both. Like I've made it both financially and kind of like socially and professionally. I'm doing what I love every single day. You know, everything that I do is growing. I have a great community of people that I managed to foster, which really, really makes me happy. And yeah, I can't really think of anything else that I would be doing that would make me more make it. I feel like I've already gotten to that point. So I think for most people, it's basically that. And I think just, you know, saying WAGMI is just kind of like a mantra that the crypto community uses to spread positive and good vibes around. You know, whether it be if the price is going up or down, it doesn't really matter. It's just all about spreading good vibes. But I mean, everything is marketing when you really think about it. Everything's narratives, but there are good and bad narratives. And I think that We're Gonna Make It is a good narrative. But at the same time, it can be used in a bad way where people say, we're going to make it. And then like they're just like dumping their tokens on you in the back room, right? So if you just take it like as like a high level, I think it's a good way to spread positive vibes around. All right, one here from Darklight1 who asks, would it be better to invest in layer 2 coins such as Matic than ETH? Talking about the long term, as most people will be interacting with Ethereum through a rollup, it seems like that would pump the price of the layer 2 coins and not the layer 1 coin. I'm sorry, Darklight, I'm going to give you the cop-out answer of I don't give investment advice. So I'm not going to answer that question directly. And also, I am an advisor to Polygon. I've invested in most of the L2's private rounds. So I have conflict of interest out the arse here. So I'm not going to give you an answer. But you know, if you've listened to any of my content, that I obviously am extremely bullish on ETH. I have said before that I don't believe that most things are going to outperform ETH over the long term. It does depend on your entry on things as well, but yeah, I can't give a direct investment advice here. I would suggest posting about this in the Discord channel somewhere. There's a lot of people looking at having the same questions as you in the community and talking about it. They might be able to give you like direct answers, but unfortunately I can't. I don't feel responsible giving an answer to that question. So sorry about that. Sorry, don't feel comfortable giving an answer. Not responsible. One here from Jan. What's something you changed your mind about in the last 3 months in the Ethereum space? This is a good question. The funny thing is, I don't want to kind of like toot my own horn here, but a lot of the things that I've been talking about for a long time have basically come true. And I don't think I've missed the mark on a lot of things. As I said, I did kind of like earlier in the year think that DeFi tokens would have performed a lot better than what they did, but that's like a market related thing. I think in terms of like fundamentals based stuff, in the last 3 months in the Ethereum space, I would actually no, this is one thing that I've been thinking about a lot lately, and this is probably just the last couple of weeks. I think that the Ethereum space can be more pragmatic and sacrifice a little bit of short-term kind of like decentralization for growth. Now, what I mean by this is that obviously the fees are high on layer 1 Ethereum because we want to keep the chain as decentralized as possible. We want users to be able to run nodes, full nodes. We want people to be able to validate the chain on consumer hardware. But what is the use of allowing users to validate the chain on consumer hardware if they can't even afford to use the chain to begin with, right? So there's that kind of like dichotomy there. And yes, I know I've said like plenty of times before that layer 1 is the settlement layer. But the thing is that between now and when we get sharding, layer 2 fees are still probably going to be relatively high, or higher than what we would like them to be. So that's, when Vitalik came along and basically proposed this thing of kind of like reducing the gas cost of call data in order to give us that scalability boost for rollups. But in doing so, there is a consequence. The consequence being that the chain becomes harder to run because you're adding more kind of state to the chain. And in the worst case, I think it adds another, how much terabytes a year? Like a few terabytes a year, I think it was 3 terabytes a year to the chain. So it does make it harder to run the chain, but as the kind of trade-off is that we get much better scalability for layer 2s. But I think it strikes a good balance. I think that, yes, it makes it harder to run the chain, but it allows layer 2s to have cheaper fees, which allows end users to have cheaper fees, and it basically allows them to use the kind of use the chain again and basically migrate to rollups faster and kind of like get people off layer 1, and then in the kind of like longer term, in the longer term, when we get sharding and things like that, it becomes less of a concern. And then obviously we have like statelessness and state expiry or history expiry and other things going on with the chain as well to make it easier to run nodes and light clients and stuff. But as I said, that's all like longer term stuff, like 2-3 years maybe for most of that stuff to be rolled out. So from that perspective, I've changed my mind on the fact that I'm happy for us to sacrifice a little bit of kind of like decentralization in that it's going to become harder for users to run nodes if we do this EIP that reduces the cost for rollups, but we get a massive boost in scalability for rollups, which to me is a fair trade. So that's something I've changed my mind in the last 3 months, or probably just like the last week, to be honest, because I was a very ardent supporter of keeping layer 1 as maximally kind of like decentralized as possible and easy to run as possible. But the argument around getting users to layer 2s and to use them as quickly as possible also fits into what I've been saying about we need to migrate everyone to layer 2. And if we can do that while only sacrificing a little bit of decentralization in the short term, then I'm happy for that to go ahead. So hopefully that answers your question, Jan. I think that's going to be it. No, there's one here from Jimma888 that comes in again. Do you think that any of the crypto debit card offerings are worth considering versus normal off ramp to bank? Any favorites? I think that they are if you kind of care about like cashback and things like that. Like I know that crypto.com has one, but the thing is, I think for the crypto.com one, they make you stake Crow tokens, so you would actually have exposure to a token. I don't know how much they make you stake. I'm sure it's not a lot, but that's kind of like a risk that you have to take on. Maybe the Crow token falls in value and you lose money or whatever. But I've heard good things about the crypto.com one in terms of like cashback, but I'm not endorsing it. I haven't tried it myself, so don't take that as an endorsement, just an example. And I think there's a bunch of others out there. If they do cashback, it might, it could be worth it. But I haven't tried any of them myself just yet. So hopefully that answers your question, Jimma. But I think that's going to be it unless anyone else has a question in the audience. Otherwise, I'm going to wrap it up for today. So I'll give it a few seconds. Just raise your hand if you have a question. If not, I'm going to end it there. All right. Well, that's it. Thank you, everyone, for tuning in to the 15th Daily Gwei AMA. I do these every 2 weeks. I think through the Christmas period, I might not do another one of these for another month or so, maybe another 5 weeks till the new year, because I'm going to be busy moving into my new house, as I announced on the refill the other day, and also it's Christmas time. So we'll see how I go. I'll announce it in the Discord channel if it will be going ahead in 2 weeks. If not, expect a new one in the new year. But yeah, thanks everyone for tuning in, and I'll see you in the Discord channel.